Gold is at record highs, but here's the twist. No one's asking the most crucial question. Everyone's obsessed with the surge, but what if this gold rush is leading us straight into a crash? It sounds unbelievable, right? Gold hitting unprecedented levels, yet history tells us this could end in disaster. Stick around, because the real question isn't if gold crashes, it's when. And what happens if it does? You'll want to stay until the end. Gold's rise in 2025 wasn't just a number, it was an undeniable statement. 64%. That's how much the price of gold jumped. To put that in perspective, the S&P 500 only saw a 16% gain. That's a huge gap. But here's the catch. We're seeing a steady, almost unbelievable rise in gold prices, yet no one's stopping to ask, what happens when it all levels off? It might feel like smooth sailing now, but history suggests that this could be the calm before the storm. Gold can't just keep going up forever, can it? The question is, what's really driving this surge, and how long can it last before reality hits? Here's the thing. The price of gold today mirrors a pattern we've seen before. In 1980, gold surged to nearly $850 an ounce, then collapsed by 65%. The big misconception? Gold doesn't crash just because it's too expensive. It falls when confidence in the dollar is restored. Think about it. Back in the late 70s, inflation was out of control, the dollar was weakening, and people turned to gold as a hedge against disaster. But when the Federal Reserve stepped up under Paul Volcker, raising interest rates to nearly 20%, gold's role as a safe haven evaporated. Inflation expectations dropped, and the dollar regained its strength. But notice what's missing from today's situation. No one's raising interest rates to 20%. In fact, they're still trying to play catch up with inflation. So ask yourself, what happens if that trust in the dollar is never restored? Let's take a step back. The gold crash in 1980 wasn't just a coincidence. It was a direct result of aggressive actions by the Federal Reserve. When they raised rates to 20%, it wasn't just a policy change. It was a message to the market. We're serious about this. Fast forward to today, and we're in an entirely different world. Real interest rates are still negative, and inflation is persistent. The Fed can't just snap its fingers and raise rates to the level needed to kill this gold rush. What's worse, we're already seeing debt levels that the U.S. hasn't dealt with before. Back in 1980, the debt-to-GDP ratio was around 30%. Today, it's over 120%. So here's the issue. The playbook from the 80s, it doesn't work anymore. Interest rates can't go high enough without crippling the economy. And that means gold is playing a different game now, one that we haven't seen before. Now let's dig deeper. Here's where it gets unsettling. Despite the Fed's efforts, today's situation feels more like the 2011 gold boom. Back then, gold hit $1,920 per ounce right after the global financial crisis and multiple rounds of money printing. Gold surged as a hedge against the fear of inflation. But guess what? Inflation never materialized. Instead, the market shifted, and by 2015, gold had fallen by 45%. But the key takeaway from 2011 is this. Gold didn't fall because it became too expensive. It fell because its role as a financial insurance policy was no longer necessary. The dollar regained its strength, real interest rates moved up, and the markets shifted back to risk on. This time, though, it's not just about inflation. It's about something deeper. The real question isn't whether gold is too expensive. It's whether it's still needed as a safe haven. Now, let's look at the rapid developments happening today. First, central banks are buying gold at record levels. This is massive, far different from the 1980s or even 2011. Why? Because they're actively diversifying away from the dollar, creating a persistent demand for gold that didn't exist before. Second, the U.S. government is buried under $38 trillion in debt. And with deficits reaching $1.8 trillion for 2025, the political will to control that debt is non-existent. Then there's the inflation problem. The Fed is still playing catch-up. Real interest rates are nowhere near high enough to combat inflation, and the dollar's role as a global reserve currency is starting to erode with countries moving away from it. All these factors are building a perfect storm. What happens if this continues? We're not just talking about a minor setback for gold. We're looking at a shift in global financial dynamics that could have major consequences. Let's zoom out for a second. What does all this mean for you? You're not just watching from the sidelines, you're in the middle of this. The average person isn't concerned about macroeconomic theory, but you care about your savings, your investments, your purchasing power. If gold continues to rise, your savings could either benefit or lose value depending on where you're holding them. But if gold crashes, what happens to the global economy? People may see their retirement accounts and investments take a hit. If this feels familiar to you, if you've seen the value of your dollar erode year after year, drop a comment below. This isn't just about big picture economics. It's about the real life effects that these financial shifts have on people like you and me. Now, let's go deeper into the mechanics behind this. Gold is responding to a system where the currency itself is backed by nothing but trust, and that trust is fragile. Here's the unsettling truth. Gold rises when confidence in fiat currencies is eroded. Right now, we're in a period of negative real interest rates, which means holding cash is actually losing you money. Gold isn't just reacting to inflation. It's reacting to the failure of the currency to preserve its value. But the big question is, how long can this last? The U.S. government is running massive deficits, and the Federal Reserve is trapped in a cycle of low rates. Meanwhile, central banks are continuing to buy gold, diversifying away from the dollar. This is not just an economic trend. It's a signal that something is wrong with the way we view money and value. And that, my friends, is exactly what makes gold such a powerful player in this game. So what comes next? There are two possible paths from here. First, we could see continued volatility and consolidation. Gold might stay within a certain range for a while, moving sideways as the world watches. This is a common scenario in bull markets. Or second, we could see sharp corrections within the ongoing bull market. A sudden 15% dip, driven by market news or political shifts, could feel catastrophic. But in the bigger picture, it would still be part of a long-term trend upward. The more unsettling scenario, however, is the third, a bear market. But for that to happen, we'd need a drastic shift in policy, something that seems nearly impossible given the current debt levels and the political climate. So what does this mean? The uncertainty is palpable. The next move could be coming soon, but it's unclear what exactly will trigger it. Here's the bottom line. Gold doesn't fall because it reaches new highs. It falls when confidence in fiat currencies returns. And right now, that confidence isn't on the horizon. When you compare today's environment to the ones that led to gold's collapse in the past, the differences are glaring. Sure, we could see corrections along the way, but a full collapse, it seems unlikely in today's landscape. So while gold might not go straight up, its role in this financial system is far from finished. And as we move forward, history will continue to shape how we view gold's place in the global economy. Want to stay ahead of the curve? Follow for more insights as we continue to break down the financial trends that could impact your future.